Hi everyone, and welcome to this week's talk where we'll cover the factor strategy returns and the sector returns for the week, month, and year to date, as well as we'll take a look at a tactical asset allocation strategy, one of the more common ones out there, which is Faber's quantitative tactical asset allocation strategy, or just the 10-month moving average. And we test it on the Nifty 50. Ideally, we should do it on a portfolio, but just to give you an example, we'll test it on the Nifty 50, and then maybe next week we'll test it on a portfolio. So with that, let's just dive in. This is just a little bit about us. And, with that, let's see how the factors have performed this week. So value has taken a hit. Value was doing well so far until last week. Could be a number of reasons. Could be the fact that the Fed chair said they're not sure of getting a soft landing. Could be the fact that markets finally pricing in demand destruction. Could be a lot of things. But we are data driven. We see we call it as we see it. So value is down about 8% in the week. Low vol and quality are down about 2.5%. So now even on a monthly basis, value is down about 9%. Momentum's down about 11, and the small caps are down about 14. And on a year-to-date basis, also value is quite negative. Small caps are down the most at about 20%. Market down about 9% until last week. This is up to the 13th of May. Let's look at the factors which are in an uptrend as of now. Now there are no factors in an uptrend. When I say factor here, please keep in mind we're talking about the long only side of the portfolio, not the short side. So in terms of value was in an uptrend and was the last one to sort of give up, and so now even value is in a downtrend. With that, let's turn to the sectors, which should not be a surprise given that value is in a downtrend. Metals and energy, the most hit last week, have recovered a little bit this week. But last week they're down about 10% for energy and 12% for metals. One of the prime reasons for value went down. On a month basis, again, metals down, hit the most. Realty is down about 13%. IT is okay, stabilizing a bit at down 6%, and FMCG down the least at about 3.5%. But year to date, it's still IT, which is down the most, about 24%, followed by realty, and energy is still holding up in the green, but metals have sort of dipped into the red now, down at down 4% for year to date. That is the calendar year. So now only one sector is up, which is energy. No surprises there. Rest all the other sectors are down in the downtrend now. Until last week, metal was holding up, but now you can see this one sector is up and 10 sectors down. So with that, if you want this in your inbox, just to subscribe to us at factorinvestor.substack.com, and you'll get all this with your inbox on a monthly basis. With that, let's move on to our topic for the week, which is a tactical asset allocation strategy and example. And they were using Faber's 10-month moving average to test on the Nifty 50. Before that, a quick reminder of what is strategic and what is tactical asset allocation. So strategic, like I said last week, is where you're taking a 60-40 portfolio. You're not changing the weight along the year. It's only once a year that the weights go out of whack too much, then you go back and rebalance the portfolio back to 60-40. In tactical asset allocation, is just a fancy way of saying that you're taking some market timing signals. In this case, we're taking the 10-month moving average. So we buy if the Nifty is above the 10-month moving average on a monthly basis, and we sell if the Nifty falls below the 10-month moving average on a monthly basis. Again, closing basis on a monthly. And typically, these can be used in a variety of ways, which I will discuss when we come to that. With that, let me show you let's go to the strategy where tool that we're going to use, which is portfolio visualizer that we're going to use. So you can see here we're using the Nifty 50. We've loaded the data. We are using the buy signal, which is price is greater than moving average. We are using a simple moving average, 10 month. There's no intra-month stop loss. Trading frequency is monthly, so no changes made on a monthly basis. And yeah, with that, let's just run the strategy. Yep. So we get about the tactical asset allocation is giving us about 10.2%, while the buy and hold has given us 11.63. So the buy and hold has outperformed purely on a return basis. But let's come to the other important part, which is the risk. And you can see the max drawdown that the moving average has seen is about of Faber's QTAA has seen is about 23%, whereas the buy and hold has seen a drawdown of 55%. And that is what is really important. Let's see the rolling returns again, and you'll see a pattern there that prior to QE that we got in 2010, it's the moving average model that is outperforming. But as low volatility went down, the buy and hold models are outperforming. And even in 2020, but you escaped from tail risk if you were with the moving average model. Even on a 10-month basis, you'll see a similar pattern where you see the 60-month. This is a five-year rolling returns chart. Again, you see in 2013, which is 5 years after 2008, you see that the buy and hold sort of picks up and starts outperforming the moving average. But again, we don't know what the next decade holds. And like I always tell people that tactical asset allocation strategies are for risk management and for avoiding tail risk and not for enhancing returns. So how should we go about thinking about this? And this is one way. So you can see here that the moving average model, which I already discussed, is down about 23%. The max drawdown that the Nifty buy and hold saw was about 55%. Now, if I wanted to make the same amount of rupee return on my moving average model, I would have to invest 12,500 to get the same return at the end of the same return in rupee terms at the end of the year. Now, theoretically, let's say, let me show this to you in Excel. So let me just share the screen. Yeah. Stop the share and then share the screen again. Yeah. So if you were to look at this Excel sheet, you can see that the amount invested, let's say, is 1 lakh, and the max drawdown that these two strategies have seen are 22% and 55%. So let's say theoretically your risk budget is around 55,000 because you're willing to take. I'm assuming you're willing to take the risk in a buy and hold strategy. So your risk is about 55,000 rupees on a 1 lakh amount invested. I'm assuming from the drawdown could come later also. And to keep things simple, I'm assuming it's from the initial capital. Whereas on the moving average strategy, your the max drawdown that you see is about 23% or 22%. So that is 2.5 times that of what you would see in a buy and hold. This is the buy and hold drawdown, whereas this is the 10-month moving average drawdown. So that's about 2.5 times. So you can theoretically get, in terms of rupees, because you're willing to take the 55,000 risk to invest in that. So now you can allocate a larger portion of your money into equity assets because you know that you are protecting your tail risk. You know that you may get a slightly lower return on your investment, but you're also taking lesser risk, and so in absolute amount you will make far more money in tactical asset allocation. So it helps you to sort of think about things in a more risk budget manner than just in terms of pure returns kind of scenario. So with that, let's go back to the presentation. I go to the slideshow. So you can see the again, one of the other advantages that you see is that the volatility of the moving average or the tactical asset allocation model is much lower. It is about 25% lower. It's a standard deviation of 16% versus 22% for the buy and hold. The swings that you see in returns are much lower. So in a very good year, you will underperform. Yes, you will. But in a pretty bad year, if if in a year in which Nifty is down about 52% and you're down 22%, I think I would take that anyway. Again, this has to be back, like I said, you should not use this only on Nifty. You should use this on a portfolio of assets, but we just used it here to make a point. Sharp ratios slightly higher. The Sortino, which takes into account only the downside returns, downside deviations, is also much higher. So, this is a point I made already, that the max drawdown in the second portfolio, the risk parity portfolio, will be much less than in the buy and hold. So to achieve the same 60,000 return at the end of the investing period, you can invest a slightly higher amount, but you also know that your risk is much lower. Your standard deviations are much lower, and your worst year, and this is the only thing that you can control. The only thing that we can control in markets is risk, and the returns are something that we cannot control. So it also has, in this case, the market correlation, because it's portfolio visualizer, maybe is taken into the US market. So, but you can see that on an overall basis also, that the moving average model has a much lower correlation than the Nifty buy and hold. So to reiterate the point again, that the main aim of these strategies are risk management and avoiding tail risk, and to cut your downside, because the upside is not known to anybody. The downside, however, can be capped or can be protected, and that is what you should be looking for in these strategies. Because once you know that, okay, you're not going to get caught in a, of course, you have to get a very quick fall, like a flash crash or something of that sort. You're not going to get protected from that. But if it's like a 2020 situation, or it's like a 2008 situation, it's like a 2017-18 situation, you will slowly get in and get out. You may get a few withdrawals along the way, but that is the price that you pay for curtailing your downside risk. So maybe if you have your core portfolio and buy and hold, you can allocate some portion to your tactical strategy, to your satellite portfolio, and you can get more rupee returns at the end of the day, because that's what matters to meet our investing goals. This is the factor all weather. There's nothing new to report here because we run this on a monthly basis, still in risk off mode. So like I said, like we showed earlier, the market is down about 10%. Gold is flat or down about 2%. So even there's relative outperformance. So we're still in the process of putting this on our website. So I think by next week we should be having it there. We published in our Factor Investor report also. So just the standard disclaimer that is not investment advice, just to give you guys an overview of the tactical asset allocation strategy, because many of you have asked for it. And please consult an investment advisor before investing. This is where you can follow me on Twitter. This is where you can follow QTAA on Twitter. This is our website. And please like, subscribe, and follow our YouTube channel. And please leave your comments below. Thank you.